Have interest rates peaked, or is there a chance that we'll see further increases in the Fed funds rate, further volatility in the market with regards to inflation readings, and we'll see higher interest rates in the future? Or is there a chance that we could see lower interest rates in the future? In today's video, I'm going to go through both arguments, where you could see interest rates go higher, why you could see interest rates go higher, and also make the case for potentially a leveling off in interest rates. Maybe this is the peak or pretty close to it, where we could see a decline in interest rates, where mortgage rates actually improve. And we'll also talk about how that's likely to affect housing as a buyer out there, as a seller out there, so that you can make informed decisions. Currently, we're sitting at a 15-year low with regards to housing affordability. Why? Because interest rates have increased nearly 2 times since the beginning of the year, going from somewhere around 3% to upwards of 6.25% just a few weeks ago. At the same time, we've seen home prices up nearly 10% just this year alone. So the cost of housing is getting more expensive. Interest rates have increased, creating strain on buyers and putting stress on affordability, which is what's causing this shift in the market that we're seeing right now, where homes are sitting a little bit longer, buyer demand is dropping off, we're seeing price declines in some markets. So what's the likelihood of interest rates staying here versus going up versus going down? Well, let's take a minute and talk about it. Now, before we do that, I'd like to ask a favor. If you find any value in this video at all, hit that thumbs up. Feel free to subscribe to the channel to stay updated on everything real estate related. So as I mentioned at the beginning of the video, you can make a case for further rate increases, for mortgage rates actually going up, and you can also make a case for interest rates going down. So what's the probability? What's the likelihood of both? Well, we're going to take a minute here and talk about it. First, I want to start by talking about the likelihood, the probability of interest rates going higher. What would cause that? Well, in order to talk about that, let's talk about where we've been over the last couple of months. What's caused the increases that we've seen so far? Because I think that will help you understand the mindset of the Fed, for one, some of the volatility out there in the market, and help you make sense of what's going on now. So back towards the beginning of the year, we started looking more closely, or the Fed started looking more closely at inflation readings. They always have their eye on it, but we started getting higher numbers, higher readings out there, and the Fed needed to do something to combat that potential rise in inflation, right? They have a target inflation rate of somewhere around 2%. So when inflation gets out of control, one of the jobs of the Fed is to control that inflation, and they do that by adjusting the Fed funds rate, by adjusting how they buy and sell mortgage-backed securities, that sort of thing. And that's what we saw. Back in March, we saw the Fed raise the Fed funds rate for the very first time, and they raised it 0.25%. But shortly after they did that adjustment with regards to the Fed funds rate, they got a higher than expected inflation reading. And basically, Powell came out and said that we should have been more aggressive on this. The market didn't like that, and interest rates started to climb. And they really started to climb right after that March meeting. And since then, we've had a lot of volatility in the market. The Fed has come out and said that their main job is to fight inflation. But at the same time, the market, they look at the history of the Fed, how they've reacted in the past to, higher than normal readings. And the market didn't really think the Fed would do what they said they were going to do, even though the Fed had come out and basically said that they were going to continue to raise the Fed funds rate throughout the year. So on and so forth. They do a couple of hikes. So initially they do that quarter hike, and then they come out and they get a little bit more aggressive after those higher readings and do a 0.5 point hike. And the market liked that, right? Because the market was expecting that 0.5 point hike. And then as we come into the June meeting, we expected the Fed to do a 0.5 point hike. That was what the market was expecting. That's what was built in. And then we got a higher than expected CPI number. Inflation reading was higher than they expected. And the Fed met about a week after that number came out and almost unanimously decided to adjust the Fed funds rate 0.75 points. And the market loved it, right? Why? Because the Fed was getting more aggressive on inflation. Now, a lot of people out there want to look at, say, hey, well, the Fed said that the housing market needs a reset, and so on and so forth. And since they've done that 0.75 point hike, the volatility in the market has somewhat subsided a little bit. And because of that, we've actually seen interest rates retrace from their recent high from just over 6.25% to somewhere around from 5.5 to 5.6%, depending on what you're looking at. So interest rates pulled back about half, maybe 0.75% from the highs because of that, that volatility subsiding, if you will. And that's because the Fed did more than the market was expecting. Now, if you go out and look at what the market is expecting for the rest of the year, then the Fed funds rate should end somewhere between 3 and 3.5%, which is about 1.5% in rate hikes that we need throughout the rest of the year. Well, the Fed actually came out today as the filming of this video and said that, there's a very good likelihood that they're going to do another 0.5 to 0.75% raise coming out in July. And so assuming that the Fed does that, the market should react positively, right? Because the Fed is giving the market what they want. And in turn, you should see the 10-year move sideways, possibly down, and interest rates likely do the same, move sideways to possibly down at the same time. Now, the question is, what could cause that to change? What could cause interest rates to actually go up? Well, the main driver that could cause interest rates to continue increasing further is if we see inflation numbers continue to surprise the market, right? If they're higher than expectations. But I know a lot of you guys are watching, the full market, not just real estate, looking at economics and everything that plays into it. And a lot of you are following GDP as well because, 2 quarters of negative growth in GDP essentially signals that we're in a recession. And so we're basically there at the moment based on the most recent readings from the Atlanta Fed showing that as of today, we're negative 2% for the second quarter, which signals that we're in a recession, we're headed into a recession, however you want to look at it. Well, recessions are deflationary by nature, which means that, less growth out there, less spending happening, less people, having excess funds to do all of these different things. And in turn, prices come down somewhat naturally. On top of that, you've got the Fed coming in and doing their intervention, if you will, by raising the Fed funds rate, by letting the balance sheet run off. And so all of these things should allow inflation to go down. Now, is it going to go down to their target of 2%? Not anytime soon. That's probably closer to 1.5 years, maybe 2 years from now, where you'll start to see the Fed reach their targets of 2%. But if inflation numbers come out as expected or less than expected, then the market should react positively. So the question of rising interest rates is, do you expect the prices of goods, of services to continue to go up, or do you see them subsiding as we head into a recession? I personally believe you're going to start to see more businesses hurt during recessionary periods. You're going to see people out there with less discretionary spending habits, right? They're not going to be spending money on frivolous things. So people are going to start to save money. And in turn, prices are going to have to pull back in a lot of these things. Now, oil and gas and some of these things we can't control, but we know as of today, even oil pulled back a little bit. Why? Because of the fear of recession. So as we head into a recession, prices should come down. And what does the Fed typically do during a recessionary period? Well, they try to stimulate the economy. Well, how does the Fed stimulate the economy? They stimulate it by backing off the Fed funds rate, right? By retracing some of their steps, by lowering the Fed funds rate. In the past, they've bought mortgage-backed securities, instead of letting the balance sheet run off, maybe they start to buy mortgage-backed securities to help stimulate the economy. Now, this won't happen immediately, but if the Fed sees the economy coming to a halt because of some of these measures they've put in place, then there's a high likelihood, a high probability that they're going to put the brakes on what they said they were going to do and help stimulate the market again. So depending on where you stand on what you think the Fed will do, kind of dictates what you think is going to happen about interest rates. But let's be clear, the Fed has a tendency of going too far in both directions, right? They overstimulate, which is essentially what they're doing now. Although they're doing the right thing now, they're doing it about 1 year late, but they also have the tendency of putting the brakes on it too soon and or going too far and then slowing it entirely, which puts us into a more dire situation with regards to the economy, and then they have to come to recover it. So I believe as we head into a deeper recession, there's a really good chance that interest rates are close to the peak or pretty close to the peak. Now, is there a chance that they move higher? Sure. I just don't think there's an opportunity for them to move much higher unless the inflation readings come out much higher than expected. And I think based on the way they calculate inflation year over year, the only chance of that happening is maybe in August. And in August, we don't have a Fed funds meeting, so there's no chance for them to actually come out and do something about a higher reading unless they do an emergency Fed funds meeting, which I'm not sure that this Fed will do. So in August, if we get a super high reading and the Fed doesn't meet, there's a chance in August that you could see a higher than expected rise in interest rates like we saw in June. But the Fed did come out in June and did a little bit more than the market was expecting and brought interest rates back down. So I think if there's any additional volatility in the market, it probably comes in that August reading, at which point that's probably close to the peak in rates that we're going to see this year, just based on the way they calculate it, unless we have another black swan event that creates more volatility in the market. So what does all of this mean for the housing market? Well, hard to say at the moment. We are in that period of summer where things start to slow down naturally. We are seeing buyer demand kind of fall off a little bit just because of interest rates going higher. We're seeing more inventory on the market. So I think, we've probably seen the peak in demand for this year, and you're likely to see home prices continue to move sideways, decelerate a little bit, possibly down in some markets. But I do believe if you saw interest rates pull back into the 4s somewhere, that could cause some buyer demand to come back to the market and continue to push things maybe even a little bit higher in some markets with regards to prices. So depending on which camp you're in, whether you're in the higher inflation camp that's going to continue, then yeah, interest rates could continue to move higher. Or if you're in the camp like me, where there's a chance that, inflation readings are going to come out pretty close to what's expected, and the Fed is going to be aggressive enough to take care of it, then there's a really good chance that we've seen pretty close to a peak in interest rates. Now, a peak meaning they could, move higher by a little bit, but not substantially, but with the probability of them likely moving lower as we head into the fall. So a lot is currently up in the air with regards to how some of these reports are going to come out, what the Fed's actually going to do, if they're going to follow through. I do believe they're going to still do their 3/4 point hike in July, which would be awesome for the market. I think the market would react positively, again, calming that volatility, allowing interest rates to potentially move down a little bit, helping buyers out there. But if you're watching this wondering lower interest rates or lower house prices, which is most important, what should I be looking for? Do me a favor, check out this video here. I dive into it in more detail. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.